at a high level, every bank is going to have to adopt this or they're going to get taken over by a neobank. And what that means is within the next 5 or 10 years, everyone who holds deposits in banks are either knowingly or unknowingly going to be holding those deposits in stablecoins.
The future of payment systems is about to change forever. What does our future look like when everything is faster, more decentralized, and easier to control? And we don't have to rely on centralized parties anymore to custody our savings and checkings. And what happens when we can actually earn high yields on our checkings accounts on the blockchain? This is the future of finance. And we'll be talking about this theme with Sudjeev Singh and Nikhil Bhardwaj, co-founders of MetaLend. Very interesting project that's working on exactly this issue. This is a sponsored interview, so do your own due diligence. This video is not investment advice. Welcome to the show, co-founders of MetaLend. Glad to have you here.
Yeah, thanks for having us.
So let's start with future adoption of stablecoins. As you know, the Genius Act recently passed. It's a federal law that creates a comprehensive framework for how payment stablecoins and digital assets would be accepted in the US. It's groundbreaking. It's very comprehensive. Let's talk about how this is going to disrupt global finance and the use of stablecoins worldwide. How will our lives change?
Yeah, I'll take that. It's very exciting times when it comes to the emergence of stablecoins and the clarity that we finally have on stablecoins and the usage of stablecoins. And this is the perfect time for it to now segue into the masses, right? There's a ton of primitives that live on the blockchain, financial primitives that stablecoins enable. Think lending, think borrowing, think payment transferring. And blockchain technology has been emerging and being developed for the last 5 to 10 years. And not, the day-to-day doesn't really feel it and haven't felt it, but now they will because of the emergence of stablecoins. So you have the on-ramps, you have the off-ramps, we'll get into that a little later, and you have interoperability, a lot of infrastructure, a lot of hard work that's been built over the last 5 to 10 years. And now regulatory clarity that'll bring in a lot of fiat into blockchain, and we'll get into all of the benefits.
At a high level, what we are expecting to see is honestly every bank in the US is going to launch their own stablecoin. The simple reason why is that stablecoins enable direct transfers instantaneously. So in a world previously today where you might have to wire somebody and wait a few days for the funds to arrive, stablecoins allow that to happen in seconds, if not less, at no cost. And so at a high level, every bank is going to have to adopt this or they're going to get taken over by a neobank. And what that means is within the next 5 or 10 years, everyone who holds deposits in banks are either knowingly or unknowingly going to be holding those deposits in stablecoins. Either they're going to hold it directly in crypto wallets or their bank will be holding it for them in stablecoins.
What do you mean unknowingly? Can the bank take your deposits, put them on the blockchain without your consent?
To some degree, they can, right? That depends how they're holding the deposits. If they want to be able to allow users to send money instantaneously and offer those features that the newer neobanks are offering, they can do that. And, unknowingly and consent, it really comes down to like terms of service and accepting those sorts of things, which a lot of people obviously don't read terms of service. They just opt in. But this is the new financial infrastructure that Nikhil was mentioning, where stablecoins are going to become the primary way that even banks hold their assets for users because they're going to need to offer these services in order to keep their customer base.
Okay, so I'll switch back to Nick. So yes, this is a common theme I've heard amongst a lot of not just crypto adopters, but even economists who point to the fact that banks face obsolescence if they don't either adopt blockchain payment rails like stablecoins or improve their existing financial payment rails like SWIFT to make it as fast as stablecoin transactions. However, here's a caveat here. I just went to Starbucks, right? I bought a coffee. I didn't pay with stablecoins because my bank doesn't allow me to hold stablecoins. It allows me to hold fiat. And so when I go to Starbucks and I use my phone, Apple Pay to pay, it's through fiat. It's not through a blockchain. So until vendors start accepting blockchain, this is a technology that isn't really relevant to the regular person. It's just a B2B payment rail. How would you respond to that?
Yeah, the time is now. We partnered with MetaMask, who has a MasterCard debit card available. It's launching in the US in a few weeks. It's available in Canada, LATAM. Hundreds of millions of dollars are being processed to merchants. Any merchant that accepts MasterCard seamlessly takes stablecoins on the other end of it. And the beauty here is there's $7 trillion at the moment sitting in US checkings accounts, just US, not even just the world. $7 trillion sitting in checkings accounts, earning 0% interest. As we all know, traditionally, checkings accounts, people don't think of them as interest bearing, but they should be. Blockchain enables that, and I'll walk through that flow. People need to save some money in their day-to-day in checkings accounts. Not everything gets put into the market, CDs, money markets, or stocks. You got to go buy the coffee, as you mentioned. Now, till the point of purchase, that dollar should be making you interest. And that's where we come in with a high earn checkings account backed by stable coins and spendability, seamless spendability with the MasterCard and MetaMask. Merchants don't even notice a difference. It's settled in the background to fiat, but the user is holding stablecoin and it's earning this morning up to 10% on that stablecoin.
Wait, so you're talking about, okay, so let's switch gears now. So you're talking about MetaLend. You're earning 10% yield on MetaLend.
That's correct.
Okay, so let's back up before we talk about the yield. How does this work?
Yeah, so I can dive into that. I think to understand how the yield here is generated, it's important to understand what are called lending protocols on the blockchain. Very simply, it is essentially like margin loans. So like you can take a loan out against your stocks. Lending protocols on the blockchain allow you to do that with crypto. So let's say you have one Bitcoin and you want to take out some money to renovate your house. You can go to a lending protocol like Aave or Morpho and deposit your collateral into a smart contract and then take out a loan. The person that's providing you that loan are actually lenders. They put their money into a pool and a borrower deposits their collateral and they take out a loan and it's an over collateralized loan. So at most, you can take 80% as a loan against the value of your Bitcoin. And then obviously the risk for the borrower is that if Bitcoin's value comes down, Aave, the protocol, automatically sells some of their Bitcoin to pay back the loan to ensure that lenders are whole. So that's how yield works on the blockchain. Now, the problem is that there's a lot of these lending protocols like Aave. And if you're a person that just wants to earn interest on your dollars, you actually have to pick first a stablecoin, which, as we mentioned, there's increasingly more and more of them. Second, you have to pick a chain like Ethereum, Solana, Base, etc. And then lastly, you have to pick a lending protocol like an Aave or a Morpho. And so there's hundreds of options for people to decide where do they want to deposit their funds. And the other thing is the rates for each of these pools changes in real time. And so the way that MetaLend generates yield for users is we sit on top of all of these protocols. You deposit your funds on a MetaLend and we find the highest pool for you and we optimize and rotate that weekly to make sure that you're earning as much as possible.
At a very high level, how would you explain MetaLend to a 10-year-old? I mean, what you're just describing, Sudjeev, it sounds like a bank. I mean, is it just a virtual bank?
In some ways, it operates as a bank, but the difference is when you're using a bank, you actually don't know what's happening with your money and where it's going, right? There's fractional banking. Yeah. They only need to hold 10% of your deposit in the bank, and then they're writing their own loans. You know, some could be mortgages, et cetera, and they're making their own risk assessments. Here, it's using open protocols on the blockchain, and within MetaLend, a user can actually go in and configure their own settings to say, hey, Aave is, the biggest protocol. They're the ones that I've heard of the most. I only want my funds to sit there. So imagine if you could go do that with your bank, right? You could go and say, I want to earn, first of all, 10 times more than savings accounts are giving right now. But secondly, you can see exactly where your funds are going to earn you yield and change it if you feel uncomfortable with where that's going and what collateral is backing it.
Okay. Nick, anything to add to that before we move on?
Yeah, just one piece to add is it's a global system now, right? One, the reason interest rates are so much higher when it comes to traditional US banks, Fed-backed rates, plus or minus 1% generally. In this case, it's pure supply and demand globally. I think it's really important to understand that there is demand to borrow, hence there's higher interest rates on the blockchain, because global emerging markets don't have any option. They don't have the sophisticated banking systems in LATAM and in East Asia. But those users now, you're seeing more and more convert their payrolls, their paychecks into stable coins, to get out of the deflationary currency. We've been seeing that for years. But now, once they're on chain, they have all of the financial primitives such as borrow, lending. And now you have a global borrowing demand that the decentralized financial system aggregates. And that's where we come in and have a layer. And just to, again, tie it fully back to that coffee you mentioned, now you can go get a coffee with that USD anywhere where they take MasterCard.
Right. I'm just going to address some probably viewer concerns at this point because this is a new project and we've seen the risks associated with new projects. We will get into the details of how this works to maybe assuage some viewer comments and concerns. However, the first parallel that maybe some people have already drawn, and myself included, is this sounds a lot like some of the instruments we've seen in 2021. Celsius ran something similar. It was later revealed to be a Ponzi scheme, and we know what happened to the company. It collapsed, and it was sued for being a Ponzi scheme. Let me just share my screen here. Celsius CEO Mashinsky, this is on an article here dated 2021 on Blockworks. To be fair to the author at the time, nobody really knew exactly what was going on before the scheme was revealed and the company was sued. But anyway, the 8.8% yield we pay on stablecoins is true value of USD. Nearly 1 million people have deposited a combined $20 billion into DeFi lending and savings pool protocol Celsius, with $1.2 billion being added every month. This also promises a payout on yield, 8.88% as of this particular article, but I knew at the time the yield did vary depending on the time and the instrument that you invested in. On stable coins, between 0.5 to 13% on other types of digital assets from Bitcoin. We know now that this was a Ponzi scheme. Most of this was paid by using other user deposits. This sounds a lot on the surface like what you guys are offering. How are you any different?
Yeah, it's a great question, very fair question. One thing to actually correct in this article, which I think has been referred to later, is here they're referring to Celsius as a DeFi protocol. That's actually not true. Celsius was centralized and a centralized service. And that's really important because what that means is when users put their funds into Celsius, they had no idea where it was going, right? That's why it was able to be a Ponzi scheme. It was a black box. People deposited their funds. And in the case of US dollars that were deposited, they were then taking those funds and basically operating like a hedge fund. They were investing in the crypto markets and giving the return back to users until obviously the market crashed and they lost all the user deposits. In the case of the digital assets mentioned here, Bitcoin, Ethereum, and the yield they offered on that, the interesting thing is they were actually using the lending protocols I just mentioned, Aave, et cetera, to take out loans against user deposits and then speculating with that. So when the market crashed, it was actually these DeFi protocols, the real DeFi protocols like Aave, that liquidated the actors like Celsius and forced them to take their losses. And they were then unable to pay back depositors because obviously they were doing things that were very illegal in terms of speculating with user funds and user deposits. MetaLend is entirely different. When a user deposits on MetaLend, you see exactly where your funds go. You can deposit and withdraw at any time, and you can update your configuration to make sure you're controlling where your funds are going. On top of that, it is entirely self-custodial. So everything is built with smart contracts. Nobody at MetaLend or even the protocols where your funds end up in can touch your funds. It's tied one-to-one with your wallet, with your private key. You're the only person that can deposit and withdraw. You're the only person that can update the configuration to determine where your funds go to earn you yield. And as I mentioned, you can see it at all times. Here's where my funds are. Now they're in this pool. This pool is, for example, taking as collateral Coinbase wrapped Bitcoin and driving yield. And if you want to withdraw, update your configuration, you can do that at any point in time.
You said 10% yield, correct? Is what MetaLend is offering?
Yeah. And to clarify, it's up to 10% yield and it's variable. So I think that's the biggest difference just in that article right there, where they guaranteed 8.8% as a fixed number, is because they were hedge funding it, right? They were saying we'll get to 8.8%. When it comes to DeFi and MetaLend, it is a variable rate based on supply and demand purely. It's so 10% is this morning. If borrowing goes down, right? If borrowing against USDC in this case, in the stablecoin, goes down globally, that interest rate will drop. In the last year, we've seen it be anywhere between 6.5% to 11%. And it's hovering right now between 9 to 10%. But it's purely variable based on supply and demand of the protocols.
Okay, can you just explain one more time how the yield is generated, and just step by step walk through the mechanism of this yield generation here?
Yeah, for sure. So essentially the way that it works, let's say I'm somebody in El Salvador. I have Bitcoin. I don't want to hold my local currency because I don't trust it. And I need some funds to renovate my home. I don't want to sell my Bitcoin. I don't want to pay taxes. So what I can do, especially because I may not trust the banking system in my country, I can go to a website like Aave or Morpho, and those websites allow me to connect my wallet, deposit my wrapped Bitcoin in this case. So Coinbase has wrapped Bitcoin. There's other companies that also wrap Bitcoin to bring them into Ethereum, and take a loan against it. For easy numbers, let's say my Bitcoin is worth 100K. I know right now it's about 110. I can take up to 80% of that value. So if Bitcoin's at 100K, I can borrow up to $80,000 in stablecoins. And I'm paying interest on that, which, as Nikhil mentioned, is a variable interest. The risk there is that if I take my max borrow, which is that $80,000, and then Bitcoin drops even to 95, Aave will automatically, with their smart contracts, sell a portion of my Bitcoin slightly below market rate to pay back my loan to get me back to 80%.
Okay, so you're paying an interest on the loan, and then the yield is, I guess,
flowing to the lenders. Exactly. So it's a two-sided marketplace. There's borrowers on one end who lock up their collateral and take out this over-collateralized loan. And there's lenders on the other end who are depositing stable coins and earning interest that's being paid by the borrower.
And then Coinbase or Aave just makes money through the spread, I guess.
Yes, exactly.
The spread.
Coinbase and Aave make the money on the spread.
So exactly how a bank operates lending.
Exactly, except this is smart contracts on the blockchain, as opposed to people making decisions and determinations about, hey, this is trustworthy collateral, et cetera. There's no humans involved in the loop here. It's all code. It's all reading financial data of what is the price of Bitcoin, what is the price of Ethereum, et cetera, when it comes to that asset, and up on a block by block basis.
Well, if there is, okay, so Coinbase is a centralized exchange. Let's just take Coinbase as an example. So if Coinbase is the custodian of my crypto and they're lending it out, and hence if I'm borrowing and I'm paying a yield, and then if I'm also staking a protocol, or in this case, depositing stablecoins, I'm being paid a yield. Well, the question I have is, how do I know if, let's say, I want to withdraw everything, they're not going to experience a, let's say, bank run scenario where they don't have enough to pay out all the depositors?
Yeah. On the Coinbase side, yes, it is an exchange, centralized exchange. But on the decentralized side, there are liquidators. All of this is automatic. So if there's, let's say, a drawdown, right, for the collateral, and people want to pay back their loans, and all the lenders want to get their funds back, it's always over collateralized. So there's always enough in the pool for all of the lenders to retrieve their deposits. And that's the beauty of it being over collateralized. And what maintains it to be over collateralized is the third arm of this, which is liquidations, right? There's an army of liquidators, mostly running bots on the blockchain. As soon as someone gets close to their limits, they sell their collateral. And that's the beauty of it here. It's all fractionalized, right? So you don't need to sell a full Bitcoin. You could sell as little as, $100 of that Bitcoin, where there's a liquidator waiting, and it keeps you under the limits at all times.
Okay, I see. Now, the next question I have is, why do we need MetaLend? Like, where does MetaLend fit into this picture? Why can't I directly just generate a yield through Coinbase or Aave, per your examples?
Yeah, it's a great question. And really, one of the initial things that we're solving here is fragmentation. So you think about lending and where you want to deposit your funds. As I said, a user needs to make three big decisions. One is what stablecoin are you going to hold? The second one is what chain are you going to move your funds to? And then thirdly, which protocol? We've talked about Aave. There's many more. There's actually hundreds of different pools. So a user could put USDC in Aave on the base chain, or they could put a different stablecoin like USDT on the Binance chain, on Morpho, et cetera. There's so many different places. And the problem is every single one of them has a variable moving rate. So it becomes very hard to optimize your money movement. And that's what MetaLend does. We sit on top of hundreds of these pools and we route your money for you to maximize your earnings. On top of that, we let you see and control exactly where your money goes. So if you, for example, don't feel comfortable with USDT because maybe they haven't passed your smell test, or I know they're still working on getting compliant with the new Genius Act requirements, you can say, I don't want my funds to go into that stablecoin, or I don't want my funds to go onto this chain or this protocol. And we take your decisions. It's encoded on the blockchain with your private key, and your money routes exactly where you want it to go.
Are there auditing systems to proof how much how much money or how many coins are in reserve?
Yeah, that's the beauty of the blockchain. It's all visible. All reserves are on chain. You can see all of on the ledger reserves, proof of reserves. There's third parties that validate proof of reserves. Those are emerging securities companies that also do that. And the one more thing I'd like to add, just as an analogy, you asked, why can't I just go directly to a protocol and earn yield?
Yeah.
The analogy there would be, in the traditional finance world, going to picking a treasury bill, right? Let's say like, hey, I'm going to pick treasury bill that's giving this yield. No, you have a banking layer on top that makes that very seamless for you. And that's where MetaLend comes in. There's also an aspect to making a seamless spending with it. But yeah.
Okay, users are concerned about security. There's been a number of hacking incidents in the last year. Bybit saw the biggest hack in history in February with over $1 billion worth of Ethereum stolen. They did resolve the issue. A lot of it was returned. I'll switch over to my screen now. MetaLend did also experience a security incident. This is on the MetaLend Twitter page. We experienced a security incident on February 1st, 2025, incidentally coinciding close to the Bybit hack incident, which resulted in the unauthorized withdrawal from our lending pools. I won't read the entire post, but what's next, our highest priority right now, is patching these vulnerabilities and making affected users whole. I will note that many users did appreciate the team's efforts in addressing this issue right away. So what happened here? Let's just address what happened in this particular security incident and what MetaLend is doing overall to enhance security.
I'll take that. We used to, before being an aggregator, earn and spend account, we used to have our own protocol similar to Aave, Compound. We used to have our own protocol. In transitioning away from that, we did have a hack where we made every user whole. We patched, we made it whole. We've sunset that protocol. It was during the moment of transitioning away from that. There was a missed security audit. We use third-party security audits, which is very common. There was a missed audit here that revealed a vulnerability during that audit. But again, our priority was to make every user whole, which we did. We now don't run a protocol. We are a UX routing layer on top of protocols. We do take security extremely we take really priority in security, but again, we don't have those risks that Aave, and that's why it's so necessary to have the layer we have, because protocols are focused on security, they're focused on liquidity, they're focused on bank runs, the questions you've asked. They're not focused on user experience and adopting the masses. Yes. The masses will not go directly to these protocols. They will go through UX layers such as ours, or they'll go through wallets where we have partnerships with MetaMask wallet and Coinbase wallets. They're going to come in through those points because it's so much easier. We still get audits done every month, multiple times a month. We get audits done. But again, we don't custody any funds. We don't manage any liquidity. That was a transitory period.
And David, to answer your broader question in terms of like DeFi, right? Even Bybit, as you mentioned, had the biggest hack in history. DeFi, of course, has had risks, and it's unfortunate every now and again you hear about a hack. And our plan for this is actually to diversify deposits, right? The key issue here is a lot of users, when you put your funds somewhere, a lot of your eggs are in one basket, right? And what we're building actually is to diversify your deposits. So a user can come in, deposit $100,000, and $1,000 will each get spread out across various different protocols. That means if something does happen, a black swan event like any of these hacks, only 1% of your funds are at risk. And because of that diversification, we can lower risk. And with lower risk, we're looking at actually being able to offer insurance for our user deposits as well. So that's something that's in the works for us. We're really excited about it. And we think that it's actually going to revolutionize DeFi and bring adoption from the masses for sure.
And just in terms of authorization and access to your own accounts, something that the Bybit hack revealed to the world is that even multi-sig authorization has failed and has been proven to fail in this particular instance. How would you address this concern?
Yeah, so one very common thing is, for example, in the case of Aave and a lot of these larger protocols, is once they built the product, then they actually get rid of the multi-sig and burn the keys. And so what that means is you can't update that version of the product. That product, those smart contracts are set in stone. They can never change. There's never even a multi-sig that was used in the initial phase of development that can't be used anymore. And so this is a very common practice. I don't think it was a practice, unfortunately, at Bybit. I think that was maybe one of their treasury accounts. I'm not exactly sure. But when it comes to these smart contracts protocols on the blockchain, they actually remove the ability for even a multi-sig to update contracts. What that means is that once it's fully audited and it's out there, there's no way to change it. It's out there and it's set in stone.
Okay, so diversifying deposits is one way to enhance DeFi security overall. You also talked to me offline about tokenizing stocks as being collateral. What can you tell us about that process?
Yeah, I'll take that. With the emergence of tokenizing stock, going back to how Sudjeev was talking about the mechanics of collateral and borrowing and lending that creates the yield, the collateral that's going to be coming on chain will be a lot more stable, liquid, right? Think stocks, think, real world assets that now can be used as collateral to borrow against. In the past, if there was a risk for lenders, the collateral wasn't strong enough, potentially, if they felt that it wasn't strong enough. Think maybe altcoins, right, that have a high volatility, not enough liquidity. Would a lender be like, hey, I don't really want that collateral backing my interest? Now we got assets coming on from the real world that will be, we're talking tons of liquidity, stable, can easier be used as price prediction, and it's really going to enable stronger yields, stable yields.
Okay. Anything to add, Sudjeev?
Yeah, I mean, I just think that the other thing that we will see with this, obviously there's people outside of the US that want to be able to buy Apple stock, want to be able to buy Tesla stock. Those people don't have access today. And tokenized stocks are going to give them access. In fact, it's also going to give people in the US 24/7 access to stock trading, which is a big feature for Robinhood, and all exchanges want to replicate that. The way to get there is tokenizing stocks. But with the global adoption of US stocks and just a global stock market, you're going to see a big increase in borrowing as well, right? Margin, et cetera. These protocols, Aave, Morpho, et cetera, they're very simple to use. They're on DeFi, and with MetaLend, we're going to be able to make it very easy for everyone to access that and have their funds move to the highest yield place.
Right. Now, what is the future of payment systems in the next 5 to 10 years? Let's suppose, and I'm not saying it will or it won't, but let's just suppose that your system takes mainstream adoption. Everyone will have some sort of DeFi checkings account that is high yield in nature, which is admittedly something that we don't usually have in our banks. But let's suppose we have that. What will the world look like in this scenario?
Yeah, we're bullish on the world looking like stablecoins being at the center of transactions, whether that's transferring funds to your family member offshore or using that to purchase a coffee. Stablecoins are more efficient. They're quicker, they're cheaper, they're faster, and they provide you exposure to the globalized economy, which is the blockchain. And we feel at this, and as Sudjeev mentioned at the top of the call, more and more stablecoins are coming for that exact reason, because these institutions know putting a stable coin at the middle of all of their transactions is the way to get more adoption, therefore also more yield. Again, all of the financial primitives open up. I'll go back to the key data point I mentioned at the top of the call, which is $7 trillion. There's no reason that money shouldn't be earning all the way till the point of purchase. That we feel like should be a common table stakes use case. And we're talking months, not years, for that to happen.
Right. Okay. And just taking a step back here, again, for the layman watching this who may be understanding what you're saying, but also going back to my example, today I purchased coffee with my credit card. The payment was instantaneous. I understand that stablecoins are inherently faster than wire transfers, but why would an average person opt to use this particular system versus just using their credit card and swiping on a payment platform?
Yeah, I mean, it's very simple. You're right, your credit card worked, but if you sign up with the MetaMask card and you take the money that's sitting in your checkings account and you move it to MetaLend, you can earn, let's say it's $10,000, you can be earning 10% on that $10,000, and then you can go with your MasterCard backed MetaMask card and buy that same coffee. You're going to get 3% cash back on the coffee, and you're going to get 10% on all the money in your checkings account until the point of purchase.
Okay. Well, great. I want to just take a few minutes to talk about your background and how your professional journey evolved to the point where you became co-founders of this project.
Yeah. On my end, I was at Amazon for 4 years prior to MetaLend, particularly the Ring engineering team. I was the right hand to the CTO. We have a global team. I was responsible for hiring, product development, the full software life cycle. And really the segue for me into blockchain and DeFi was we had a huge set of users in Latin America, specifically Argentina. Sorry, not users, engineers. We had a team of about 200 engineers for Amazon and Ring in Latin America. And what they would do immediately is when they received their payroll, they would convert it to stables or they would convert it to crypto. A, to get away from deflationary risk on their local currency. And B, again, to open up all of the financial primitives that are, like the US has, borrow, lending, and so forth, leverage, earning against it. And then I went down the rabbit hole of the blockchain. I was fascinated. A little bit of personal background between Sudjeev and I. At that time, it was COVID. We were roommates on a whiteboard talking about blockchain and decentralized finance. We ripped apart Aave and Compound and all of their algorithms, and we were fascinated by it. Started personally using DeFi as a lender to make some money. We were holding Bitcoin and Ethereum as just personal interest. And yeah, have immense personal trust with Sudjeev. We've traveled the world together. Again, we built MetaLend to start as roommates. He's married now, so we're not roommates, but that's the story on how MetaLend started. Backed by Pantera, thanks to that team. They've really been a strong advocate, as is a lot of our partners like MetaMask and a few others exciting partners coming.
Yeah. And on my end, as Nikhil mentioned, also have a Web2 background. Started off at ZipRecruiter, the jobs company, ran marketplace products there, and then transitioned to Bird, the scooter company, where I also ran product and marketplace. Eventually ended up running growth at Bird and was in charge of basically making sure vehicles were in the right place at the right time to maximize rides and revenue for the business. And so while it's a very different type of product and business, it's actually very similar in terms of the supply demand issue, moving, in this case, assets to places where they can earn the highest yield whenever there's supply and demand imbalance. On a personal note, I actually grew up in Mexico City. So from age 3 to 18, I grew up in Mexico City, and my whole family for the longest time was earning in pesos. They're business owners down there, but they were always trying to think about how do we hold everything that we're earning in an asset that can last for the long term. So US dollars, gold, et cetera. I think Nikhil and I are both really excited about the products that we're building, being able to impact the lives of everyone that we've talked about, from his engineering team in Argentina to my whole family and everyone that I know in Mexico, and make it easy for them to hold stable coins, earn high yield, and be able to spend on the day-to-day.
Do you both have engineering backgrounds?
Yeah,
Yes.
we do.
And when you say that you're backed by Pantera, can you just disclose, the fundraising process, roughly how much was funded, and any other notable partners that you may have?
Yeah, Pantera led our seed round. We did a seed round, $5 million that they led. Collab and Currency also co-led with that. Since then, Pantera's also doubled down on us and has done another check. We'll be doing another fundraising within the next 6 months. We're focused on really every day asking our team, and you've asked a few times during this interview, can our moms use this product? And we ask the team that every day. That's our North Star here, is to enable our moms to be able to use this product and really benefit from the advantages of the blockchain. After we've nailed that experience, we're close. We'll be doing another fundraising round.
Well, I appreciate the time, gentlemen. Thank you very much for educating us on stablecoins and MetaLend. And good luck to your venture. Appreciate it, and we'll talk again soon.
Awesome. Thank you so much.
Thank you for watching. Don't forget to like and subscribe.